In the modern financial world, far away from the classic trader profile who sits in front of a screen for hours drawing lines on charts, looking for support and resistance points, and trying to read the future from candle formations or complex geometric structures, there is a completely different universe that operates with mathematics, statistics, and systematic data analysis. When we want to understand this universe and modern quantitative investing, one of the deepest and most impactful figures we encounter is undoubtedly Cliff Asness. Today, as the co-founder, managing partner, and chief investment officer of AQR Capital Management, managing billions of dollars in funds, Asness looks at the market neither through the eyes of a completely romantic trader nor like a rigid academic who accepts the market as 100% perfect and unbeatable. His view of the market is completely outside traditional visual technical analysis tools like trend lines, support and resistance levels, chart patterns, candlestick structures, or popularly known fair value gaps and order blocks. Focusing on the long-term statistical behavior of prices and fundamental data rather than the shapes he sees on a chart, the definition of technical analysis for Asness consists of momentum, relative strength, value spread, risk premium, behavioral errors, and data tests spanning centuries. In other words, Cliff Asness is a system investor who tries to read the market not by drawing lines on a chart, but by systematically measuring price, value, momentum, and human error. The most important value Asness assigns to price action emerges on the momentum side, where he has made massive contributions to the financial literature. In his world, momentum is not a simple copycat mechanism, like blindly buying an asset whose price is rising without looking back. Momentum is based on the statistical probability that assets that have shown strong performance in the past 6 to 12 months, especially compared to other assets, will tend to maintain this strength for a while longer. When measuring momentum in his financial models, we see that he usually excludes the most recent month of data. The reason for this is to prevent short-term microstructures, instantaneous liquidity shocks, and market noise from distorting the measurement, meaning to avoid short-term reactivity. This approach is a medium-term statistical price behavior rather than the short-term trading signals we know and look for on daily charts. At this exact point, a very critical distinction must be underlined. Asness positions momentum and trend following as two concepts that are very close but definitely not the same. Momentum measures the past performance of assets relative to each other, meaning their relative strength. Trend following, on the other hand, mostly tracks the absolute price direction of an asset, its own moving averages, or price channels. In Cliff Asness's world, momentum is not jumping onto a rising asset with a populist approach. It is the systematic selection of strong assets among different asset classes or stocks, the elimination of weak ones, or evaluating them on the short side. Therefore, his approach is a completely measurable and mathematical momentum analysis rather than a visual chart reading process. To understand the roots of this philosophy, we need to look at Cliff Asness's academic background at the University of Chicago. Here, he has the privilege of being both a student and an assistant to Eugene Fama, the father of the efficient market hypothesis and one of the greatest theorists of modern finance. The interesting and courageous part of the story is that while Asness was raised in this academic environment, which is the fortress of the completely rational and perfect market idea, he chose momentum, a concept that directly challenges the efficient market theory, as the main part of his doctoral dissertation. In his own narratives, he mentions that telling his professor Fama that momentum actually works in real markets and that prices are not always rational required great academic courage. However, Fama's guiding answer summarizes Asness's entire career logic and system development ethics. If it's in the data, write the paper. This very sentence is the foundation of the philosophy of believing not in beliefs, but in data, not in stories, but in proof, not in abstract theories, but in real market behaviors tested by theory. After completing his academic research, Asness, who began managing real money at Goldman Sachs, personally experiences how theoretical ideas face harsh realities, such as transaction costs, liquidity constraints, and investor psychology. This experience allows him to use research not just to write papers, but to build systems that can survive the stress periods of the real world. This balanced stance in his view of the market separates him from many market players. Asness does not see the market as completely inefficient, manipulative, or an area that can be easily defeated around every corner. On the contrary, he accepts that the market is a very powerful mechanism that processes information extremely quickly, keeps active managers under massive pressure, and makes it difficult to beat indices. He does not worship the market, but he has tremendous respect for it. He takes the efficient market hypothesis, which argues that prices largely reflect all available information, seriously, but he does not claim that prices are perfect and reasonable at every moment. This is exactly where he positions himself in his famous works. Markets are not perfectly efficient, but market efficiency should always be the safest and most disciplined starting point when designing an investment system. If you have very strong and long-term historical data sets that prove otherwise, only then can you think about getting a step ahead of the market. This situation is a shocking lesson for two groups of traders on opposite extremes: those who view the market as entirely consisting of manipulation and look down on systems, and those who believe the market knows everything perfectly and think there are no opportunities. Asness rejects both extremes. He believes that human behaviors, emotional reactions of crowds, and institutional constraints leave indelible marks on prices. Crowds sometimes pay excessive amounts of money for popular and expensive stories, abandon cheap but boring values, create extreme euphoria by magnifying good news, and cause panic selling by over-penalizing bad news. The quantitative system approach, then, is the art of catching these human and structural errors with mathematical data. The greatest strategic move that brought Cliff Asness global success is his combination of two massive factors generally seen as rivals in the financial world: value and momentum, under the same roof as complementary elements. Classic value investing looks for assets that are cheap, whose balance sheets are strong but ignored by the market. Momentum, on the other hand, follows strong assets whose direction is upward and demanded by the market. According to the traditional perspective, these two approaches seem completely opposite to each other, because one buys the cheap asset that has fallen or remained flat, while the other selects the one that is rising. However, in Asness's mathematical models, these two factors create a perfect balance mechanism when brought together. Sometimes a cheap asset can continue to stay cheap for a very long time due to structural problems or market indifference. This is exactly where momentum acts as a filter, allowing us to understand when that asset is reviving. On the other hand, an asset that skyrockets by taking momentum behind it can become unreasonably expensive through extreme euphoria and speculation. The value factor steps in at this stage to provide risk management and prevent us from getting caught up in extreme enthusiasm. In his academic papers, he proves that momentum is not a temporary, small, or random market fluctuation, but on the contrary, a deeply rooted anomaly that works consistently in historical data spanning more than 2 centuries in American stock markets, in different countries, and across a wide variety of asset classes, from commodities to currencies. However, momentum is not a holy grail on its own. It shows its most devastating and powerful performance when combined with other negatively correlated factors like value. In historical simulations, it is clearly seen how much the largest capital erosions experienced when focusing only on the value factor, or the massive drops encountered when relying only on momentum, are radically softened when a balanced combination of these two factors is used. This data is the most concrete proof that a system trader should not blindly bind themselves to a single indicator or a single signal, but should use reasonable system components that balance each other together. With the digitalization of financial markets, the integration of artificial intelligence, and the dizzying speed of technology, information now spreads across the world in seconds, and anyone can trade in global markets with a single touch from their smartphones. At first glance, this situation is expected to make markets much more efficient and error-free. However, Cliff Asness makes one of the most important financial observations of modern times at this point. The speed at which information enters prices and the accuracy of that price are absolutely not the same thing. The echo chambers of social media, instantaneous news feeds, the 24-hour continuous trading culture, and the gamified structure of trading processes have not reduced the effects of human psychology on the market, but on the contrary, have made them larger and more aggressive. Asness argues that, especially over the last 30 years, markets may have become less efficient, meaning more erroneous, in some areas of the relative pricing of stocks and assets. Technological speed causes crowds to run after the same story with the same enthusiasm at the same time. This pushes what is expensive to be even more expensive beyond the limits of logic, and drives cheap and disgraced values into an unfairly deeper abandonment. This situation is a vital perspective for those of us trying to understand market mechanics. No matter how much technology accelerates the market, human psychology, the fundamental dynamic that moves the price, and its systematic errors never disappear. They only change skin and give faster reactions. The solution to surviving in this new market structure is not running after short-term excitements, social media speculations, or instant price fluctuations, but staying loyal to a systematic investment process based on disciplined, cold-blooded, and long-term statistical evidence. One of the most shocking realities that system developers and those interested in technical analysis must face is the nature of historical tests, namely backtest studies, and their relationship with real-life performance. Most of us assume that when we find an indicator combination or an algorithm that gives excellent results on historical data and draws a perfect profit chart, the same results will be copied identically in the future. Cliff Asness presents a very clear and realistic investment ethic in this regard. He never sees historical tests as a promise for the future or an absolute guarantee. He accepts them only as maps that allow us to understand probability boundaries and market logic. In real market conditions, due to transaction costs, liquidity slippages, and changing market regimes, he argues that obtaining even half of a backtest performance is an excellent result. The success of a system cannot be measured solely by how much money it makes in theory. True success is hidden in the periods of poor performance that the system will inevitably experience, namely the drawdown processes. Even the strongest mathematical models that yield the most profit in the long run can produce consecutive losses by failing to adapt to market conditions for months or even years. The fact that a strategy is theoretically correct and logical does not mean that it will make uninterrupted money every month or every year. Many investors and traders panic and abandon the strategy in the first few months when the performance of a system deteriorates and enters a drawdown period, searching for another magic formula. Yet, the greatest reality of the financial sector and professional fund management is patience and the capacity to philosophically endure these challenging periods. If you do not deeply know the economic logic behind the system you use, why price movement is rationalized by that indicator or that mathematical model, you will lose your faith at the first difficult bend and throw your system into the trash. However, if you trust the logic, test quality, and long-term statistical advantage of your system, you will rationally question and update your model during those bad periods, but you will not change your route with panic and emotional decisions. In conclusion, the clearest, most refined lesson we can draw from Cliff Asness's life, academic studies, and the massive quantitative system philosophy he established is this: achieving permanent and sustainable success in financial markets is not about finding a secret indicator, a hidden chart formation that nobody knows, or a perfect signal whose every prediction comes true. The market is a rival too sophisticated, dynamic, and challenging to be defeated with a single holy signal. A true system investor must always approach the market with deep respect, far from arrogance. Those who can melt the momentum information of price action, fundamental value multiples of assets, institutional mechanisms, and systematic errors of human psychology in a single analytical pot survive in the long run. From the perspective of technical analysis and system design, a signal or a rule set has no magical value on its own. A trade idea is valuable only if it contains a logical economic or behavioral explanation behind it, if it has been tested and verified under different market conditions spanning centuries, if the magnitude and duration of the bad periods it will experience are accepted from the beginning, and most importantly, if it is within the risk boundaries that the investor can psychologically carry. Staying permanent in the market and growing capital is possible not by having the brightest or most popular idea, but by having the unwavering discipline to hold on to a rational, tested, and logical idea even in the most difficult times.
Thank you for watching our video. In the next episode, we will examine the journey of another legendary trader. Don't forget to subscribe and turn on notifications. For more content and strategies, you can join our Telegram channel. The link is in the description.